A funny thing happened on the way to the U.S. recession of 2024. The irrepressible American economy refused to play along. At the start of the year, investors around the world were looking for as many as 6-quarter-point interest rate cuts from the Federal Reserve to protect economic growth and fight inflation. But inflation has stayed stubbornly above the central bank's 2% target, and the economy keeps growing despite an overnight interest rate target range of 5.25 to 5.5%, the most among the group of 7 industrial countries. By early February, those 6 rate cuts had become 3, and on Wednesday, Fed Chair Jerome Powell gave the world the idea that there might not be any. In the circumspect language of a central banker, he said, "We do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The central bank did throw the market a bone in the form of slowing sales of bonds from its own portfolio more sharply than had been expected. And Powell said he did not think inflation was so strong that the Fed is likely to want to raise rates." Treasury bond prices rose, a sign of relief that the interest rate news was not worse, and stocks and the dollar held firm. In the normal course of events, you could expect a tight monetary policy to curb economic growth and put a lid on stock gains. But Wall Street keeps rising and the dollar remains strong, and investors keep financing Washington's budget deficits. At the heart of this apparent conundrum is the idea that there is something special about the United States and its economy, an old idea that has been gaining popularity for more than a decade. The exceptional performance of the U.S. economy, both in absolute terms and relative to other countries, reflects the powerful combination of existing attributes and steps taken to invest in the engine of tomorrow's growth, says Mohamed El-Erian, chief economic advisor to the Munich-based insurer Allianz as well as president of Queen's College at Cambridge University. 5-year dollar-adjusted performances of major stock market indexes in percent. In 2010, just off the depths of the great financial crisis, El-Erian was co-chief executive officer of Pacific Investment Management, a subsidiary of Allianz. In a television interview that year, he began referring to the U.S. as the cleanest dirty shirt among major economies, and the description was echoed by Bill Gross, his co-CIO at Pimco. At the time, America remained insulated from economic turmoil in Greece that was souring the outlook for its partners in the European Union, its financial markets benefiting from a flight to perceived quality. People still use the phrase to compare the U.S.